Friends, let us make a beginning with section 144A, that is powers of the Joint Commissioner to issue the directions in certain cases. First, let us try to understand what made us to bring this particular provision into the law. Sometimes it may so happen that there is a point in the assessment which is to be decided, and the assessing officer is in fix what to do, in which case definitely a person higher than him, if he gives some direction, it becomes easy, and also the process of the assessment can be speeded up. That is the intent in saying that a power is given to the Joint Commissioner to issue directions in certain cases. See, here try to understand the very intent of this section is nowhere that a Joint Commissioner can influence the process of assessment. The very purpose here is to give some direction so that the assessing officer will be able to finish off the assessment quickly if there is a fix. So now how the section reads is like a Joint Commissioner on his own motion, suo motu, or on a reference made to him by the assessing officer, that is, if assessing officer asks for it, or on the application of an SSC. So under these three circumstances, what are the three circumstances? Suo motu on his own, or on the request of the assessing officer, or on an application by the SSC, call for and examine any proceedings in which the assessment is pending. So he can call for all the records, he can examine those records and can give some directions to the assessing officer to complete the assessment is a point. See, if he consider that having regard to the nature of the case and the amount involved in it, or for any other reason, it is so necessary that he should necessarily give the directions to enable the assessing officer to complete the assessment. Try to understand the point. It's not like he takes away the case from the assessing officer and completes the assessment. He only takes the records and examines the records, see how the proceedings are moving, and then gives the direction depending upon the nature of the case and amount involved, and for any other good reason he can do like that and can give the direction to the assessing officer. Of course, whatever the direction given by the Joint Commissioner, necessarily the assessing officer need to adopt it. The answer for that is it is not binding on the assessing officer. And then let us suppose a particular direction is given by the Joint Commissioner. In case if that direction is going to be adopted and the assessment is going to get completed, it is going to affect the interest of the SSC. In such situation, an opportunity of being heard must be given to the SSC is a point. So directions as to the lines on which investigation connected with the assessment should be made and shall not be deemed to be a direction prejudicial to the SSC. See, not that all the directions automatically will be prejudicial to the interest of the SSC. Let us suppose the Joint Commissioner says, in this manner you proceed with that particular assessment. Automatically will it be a fit case to inform to the SSC and say that this is what we are going to do? That is not required. If there is any specific direction by the Joint Commissioner in respect of a particular aspect, and adopting such a direction is going to create some effect on the SSC, then an opportunity of being heard must be given as a point. So what are the important points? Make note in section 144A. Section 144A deals with, friends, that is power of the Joint Commissioner, to issue directions, in certain cases, Point number 1. Most important thing is there should be a pending assessment proceeding or reassessment proceeding before the assessing officer. Only when there is a pending assessment or reassessment proceeding, in respect of that pending assessment or reassessment proceeding only, what is it? A direction can be issued. Not that when the case is not pending before the assessing officer, Joint Commissioner cannot just call the assessing officer and say that let us take up a very interesting and beautiful case of Mr. Chakravarti and let us start initiating the reassessment proceeding. Like that he can't say. In case if Chakravarti's case is pending under the assessment or reassessment proceeding before the assessing officer, then the Joint Commissioner can issue the direction. Write down the direction under section 144A. The direction under section 144A can be issued only if case is pending in an assessment oblique reassessment. Then another issue which you need to remember is, need not write, Joint Commissioner using the power under section 144A can only issue directions to the persons below the rank of Joint Commissioner. Not that I got a power under section 144A bolke, he can't issue a direction to the commissioners and chief commissioners. He can only issue directions to the assistant commissioner, deputy commissioner and the income tax officer. And one more important thing is, once the direction is given by the Joint Commissioner, means it could be a favorable one to the SSC or it could be something which is against the SSC. Need not necessarily be that whatever the directions given by the Joint Commissioner necessarily should go against the SSC and should not be favorable to the SSC. That is not the purpose you intend here. The direction which he is giving could be a favorable one or it could be against the SSC. Only thing is, if it is against the SSC, an opportunity of being heard must be given to the SSC is the point. Of course, friends, an appeal can be filed against the directions issued by Joint Commissioner under section 144A. Point here is no appeal, because appeal, friends, try to understand, is not your natural right. Only when specifically it is provided under the law that this is an appealable situation, you can appeal. For all the acts of the assessing officers and the income tax authorities, you can't go and make an appeal. So point to be remembered is, this is not an appealable situation. Write down. No appeal can be filed against the directions issued under section 144A. Of course, what should be clear in your mind? Earlier also we studied a point. Special audit. Can SSC challenge that special audit? No. Only thing is, in case if the assessing officer using that particular special audit is going to complete his assessment, he can very well challenge the assessment by making an appeal against such assessment order. Like that only here also, you can't challenge the directions of the Joint Commissioner, but in case if using those directions, if the assessing officer is going to pass an assessment order, nothing prohibits an SSC from challenging such a assessment order passed by giving due consideration to the directions issued by the assessing officer, is a point to be issued by the Joint Commissioner. In case if the assessing officer is going to complete the assessment, then such assessment order can be very well be, what is it, challenged. But as it is, the point is, directions cannot be challenged. Then friends, Joint Commissioner issued directions under section 144A to the Assistant Commissioner and Deputy Commissioner handling the assessment of the brokers who are involved in the security scam, that while making the assessment of those brokers, Assistant Commissioner and Deputy Commissioner should investigate the dealings of the broker, investigate the dealings of the brokers with other brokers and foreign institutional investors, investigate how loan from the banks has been used by those brokers. Let us suppose there is a specific class, say brokers, those who are involved in the security scam. With respect to them, you investigate on all these aspects, बोल के directions दे सकते, very much he can give directions in such situations and for those purposes. Of course, again and again we are saying the same point. In order to give effect to the directions, if the assessing officer is going to do something which is going to be against the SSC, an opportunity of being heard should be given. That is most important. Other way around, they can challenge the assessment orders by saying that assessing officer acted on the direction of the Joint Commissioner without giving us an opportunity of being heard, is the point. Now with that I completed section 144A. What are the powers of a Joint Commissioner and under what circumstances he is going to give the directions, and will those directions be binding on the assessing officers? Can the SSCs can challenge the, what is it, directions given by the Joint Commissioner using the power under section 144A? These aspects we completed. Now we move to the next section, section 145. Friends, try to remember, we discussed this particular section of 145 and 145A even under the head profits and gains from business and profession. When we were making that discussion, there also we discussed this aspect of method of accounting under section 145 and then the method of valuation of inventory. Of course, by now you are all clear with one point. Method of accounting, mercantile system or cash system. It is relevant only under two heads of income. What are those two heads of income? One is profits and gains from business and profession, and another is the income from other sources. You are using which method of accounting will decide what is your income. So in that context, try to understand method of accounting is relevant only under two heads of income, while computing the income under the head profits and gains from business and profession, income from other sources. You should adopt either of these methods, that is a cash system or accrual system, but whatever the method that you are adopting, it must be regularly be followed. That's what in tax audit report under section 44 AB also they will ask what is a method of accounting adopted by the SSE and is it being regularly being followed. See, why for the other three heads of income method of accounting is not relevant? Because for each head of income there is a charging section, chargeability section. For the head income from salaries, charging section is what? Section 15. For the head income from house property, what is the charging section? Section 22. 22 is the charging section. 23 discuss about the annual value. 24 discuss about the deductions available. And charging section under the head profits and gains from business and profession is section 28. Charging section under the head capital gains is both section 45 and 46. Then under the head income from other sources, the charging section is what? Section 56. The beginning section is the charging section. Your charging section under the head salaries says what? Income under the head salaries will get taxed either on receipt basis or on accrual basis, whichever is earlier. So there the method of accounting in which way you are accounting your salary income does not have any role. Similarly, your charging section under the head income from house property says what? It is the annual value of the house property which should be given due consideration to say what is your income under the head income from house property. That is, while calculating that annual value, due consideration must be given to the fair rental value, standard rent, municipal valuation, then actual rental value. So irrespective of the fact whether you received it or not, it is the annual value. It's not that only rent received or receivable is a consideration, it is the annual value which you should offer it as a income. Similarly, under the head capital gains, what is it? There should be a capital asset and it should have undergone transfer. So the year in which such transfer takes place, SSC need to offer that particular income, irrespective of the fact whether he received that particular amount of sale consideration or not. So under those three heads, your method of accounting does not have any role to decide what is the income. But method of accounting is very much relevant under two heads. One is the profits and gains from business and profession, and another is the income from other sources. It's a point. Friends, try to understand. We discussed section 144, best judgment assessment. Under what circumstances assessing officer can initiate the best judgment assessment? One of those circumstances is, in case if the assessing officer feels that the accounts are not correct and complete, and method of accounting which they have adopted, they are continuously changing, not regularly employing. And whatever the method of accounting they are adopting is not going to give a correct profit, then very well it is a fit case to be taken up for the, what is it, best judgment assessment. Of course, automatically he will not jump, he will give sufficient opportunity by way of a show cause notice, and sometimes when there is complexity in the particular accounts, then they can very well initiate the special tax audit also. Despite of all this, in case if the assessing officer fails, he can take up the case for the best judgment assessment. So that is the relevance of the method of accounting. So write down few points on method of accounting. It is section 145. Point number 1. Income under the head profits and gains from business and profession. Income under the head profits and gains from business and profession. And income under the head income from other sources shall be computed in accordance with either cash system or accrual system of accounting, regularly employed by the SSE, Then friends, next point. If the assessing officer is not satisfied with correctness or completeness of the accounts, or where he found no method of accounting, has been regularly employed, then where the assessing officer found that income is not computed. Income is not computed in accordance with accounting standards notified by central government, then he can take up the case. For best judgment assessment. Yes. By now you are clear with one point. When and under what circumstances assessing officer can take up the case for best judgment, and we are only adding one more point. What is that point just now we have added? If the assessing officer feels that the accounts prepared are not correct and they are not consistently using the same method of accounting. Similarly, the income so derived is not by strictly adhering to the accounting standards which are being notified by the, not Institute of Chartered Accountants of India, notified by the central government, then he can very well, take up the case for the best judgment. Yes. Many a time we get doubts after sitting in the exam or when we are in the client's place, not when we are with the books or not when we are reading the books. Why? Because in both the places of examination hall and in the client's place, of course examination hall is a more dynamic place compared to the client's place. In the client's place, if you are in a fix, you can always say that I will refer the book and tell, or I will ask my senior and can tell. In the examination, probably that may not happen. That's the reason why most important thing for a student to qualify is not to read what it is, how it is, as it is. Yes, that you have done till the PE2 level. But as a finalist, you should be able to feel the situation and should be able to view. Probably a question can also be set like this. I can't visualize if somebody says, I don't think so there is a chance for such a person in the present scenario to become a chartered accountant. Probably 15 years before, when I am pursuing my CA, remote chance like that also passing is there, but today all are practical questions. In that context, the approach of study entirely need to be more thinking and visualizing the situation. Try to understand the point, friends. What are all the possible type of issues that may crop in? SSE can adopt the cash system for one business and accrual system for another business. Similarly, SSE can adopt the cash system for one source of income and can adopt accrual system for another source of income. Nothing prohibits. Generally, we feel once the SSE adopts one particular system of accounting for one particular source of income, the same need to be adopted for all the sources. So, such kind of the feeling, take it away. Only intent here is to tell that for a particular source, stick on either to the cash system or the accrual system and employ the same regularly is the point. Right? So, tomorrow when you go to the audit also, there check whether consistently the same system is being followed. Don't question them that for that you have adopted that system, for this you are adopting this system. They can very well adopt it. Nothing prohibits, nor a prohibitory thing is being stated in section 145. Write down. The SSE can adopt, cash system for one business, and accrual system for another business. Similarly, SSE can adopt cash system for one source and accrual system for another source under the same head. Now the point of interest is what? Like when we studied the accounting standard 1, what is accounting standard 1? Disclosure of significant accounting policies. And accounting standard 5, what is accounting standard 5? Prior period items, extraordinary items and changes in the accounting policies and all those things. Is there any prohibition on change in the method of accounting? As it is, there is no prohibition. But under what circumstances a change can be made, friends? We are revising that standard. 3 circumstances. One is, if a statute governing the enterprise requires such a change, or second thing is, if the accounting standards issued by the Institute of Chartered Accountants of India require such a change. Third is what? If the accountant feels that such a change would enable him to show the true and fair situation, true profits and true financial statement position, then he can adopt a change. Like that, even under the income tax law also, please remember, as it is, there is no prohibition for a bona fide reason, not with the intention to make window dressing. For a bona fide reason, in case if SSE is bringing a change in the method of accounting, then department necessarily have to accept such change in the method, even if it is going to result in a loss to the revenue. Write down this point. SC can change. SSC can change method of accounting. Method of accounting employed by him. Employed by him. Provided that change is bona fide. Change is for a bona fide. Change is for a bona fide reason. Bona fide reason. Continuation. The department shall have to. The department shall have to accept the changed method. Shall have to accept the changed method even if it results in a loss to the revenue. Even if it results in a loss to the revenue. Friends, try to understand valuation of a stock, another important area. Valuation of the stock, what is stated? It must be done at a cost or market value or NRV, whichever is a lower. While arriving at the costs, there are several methods, FIFO, LIFO, weighted average and all that. But under the income tax law, which method is permitted? That is a FIFO method is acceptable. Write down this point. In income tax, FIFO method of valuation of a stock, FIFO method of valuation of the stock is acceptable. Is acceptable. Right. Now I move to section 145A. That is method of accounting in certain cases, or more precisely this is a valuation of the stock. Yes, valuation of the stock is definitely a cause of concern. Whether you are doing the tax audit under 44AB or a statutory audit under the Companies Act. Because that is one item of account which can bring a change in the profits. Overvaluation will enhance the profit. Overvaluation of the closing stock will increase the profit. Undervaluation of the closing stock will decrease the profit. So any window dressing with respect to the profit one has to do means they are going to do by inflating or decreasing the stock. So as a future auditor, you should be very, very careful with respect to the valuation of inventory. That's the reason why our institute also issued a standard on it. What can be included in the cost, what should be excluded from the cost. Of course, friends, sometimes what will happen is, what is stated in the income tax law could tangentially differ from what is stated in the accounting standards. But as a students, all of you are aware of the point that whenever there is a contrary to what is stated in the accounting standard, what will have a overriding effect? Always what is stated in the statute will prevail over what is stated in the accounting standards. All this discussion we are making for the simple reason, when I purchase the stocks, I will be paying some duties in respect of which moderate credit or senvat credit is available. What is it? Somebody's output is my input. So while purchasing that particular item from that particular manufacturer, that is my raw material is finished goods for somebody. Excise duty is what? A duty on manufacturer. So my seller, who happens to be the manufacturer, is going to collect from me the excise duty and remit the same to the government. Now my inputs, that is inventory, includes excise duty, and in respect of the excise duty which I paid, I am having a eligibility to get the senvat credits claim. Then while valuing the closing stock, whether duty which I paid is to be included, or by the reasoning that since anyhow I am going to get the credit in respect of the duty which I paid in the input, whatever the excise duty component in the value of the closing stock, is it to be included or excluded is the point. What our loss is. Look at, write down. Notwithstanding, section 145A, valuation stock. Section 145A, valuation of stock. Write down. Notwithstanding anything contained, anything contrary contained in section 145 point number A, the valuation of the inventory, for the purpose of income chargeable, for the purpose of determining the income chargeable, under the head profits and gains from business and profession, under the head profits and gains from business and profession, shall be in accordance with method of accounting regularly employed by the SSC. Next, inventory shall include, this is most important point, inventory shall include the amount of any tax comma duty, comma cess, actually paid or incurred, to bring the goods, to the place of its location and condition as on the date of valuation. Condition as on the date of valuation. Note, even if tax paid on purchase, tax paid on purchase, tax बोले तो excise tax paid on purchase is having a right to claim the Senvat credit, at a later date still excise duty is to be included, still excise duty is to be included while computing or while arriving at the value of the stock. So under the income tax law, by now you are through with the point. What is the point? Whether credit is available or not. Once you paid the tax at the time of purchase of the goods, such a tax must be included while valuing the closing stock is a point. This is not the position with respect to valuation when it comes to the point of the accounting standards. That's where adjustments are warranted while when we compute the the income under the head profits and gains from business and profession. Now friends, let us suppose you received interest on the compensation or enhanced compensation. It shall be treated as income of which year? Is it to be treated as the income of the year of accrual or the year of receipt? Try to understand where we are. See, compensation and all this, where we have discussed? We have discussed when compulsory acquisition happens, compensation will be given. Similarly, if business is acquired by the government, then also it may award some compensation. Now the point of interest is there is a delay in paying the compensation or additional compensation. Consequently, interest is paid. Irrespective of the method of accounting that you are adopting, interest on compensation or enhanced compensation is going to be treated as the income of the year in which it is received, not in the year in which it is accrued is the point. Right? This is also an exception because we are discussing the method of accounting being regularly adopted Please take this point also. Write down. Interest received by an SSC. Interest received by an SSC on compensation or enhanced compensation. On compensation or enhanced compensation shall be deemed to be the income of the year, shall be deemed to be the income of the year in which it is received. Now friends, we need to again get back to what is it? What we were doing, the assessment procedure. There I completed regular assessment under section 143 and 144. Now we need to move to section 147, that is assessment and reassessment under section 147, wherein we need to discuss elaborately the provisions of section 147, 148, 149, 150. Probably it may take an hour to visit all that, but I expect the student to have more patience, more keen listening when we are going to discuss the provisions of section 147, 148, 149 and 150. Because so far what we have studied is not having so much of the complex issues compared to what we are going to do now. So let us understand clearly what is this particular assessment and reassessment under section 147. Of course, to give you a overall view, please do remember section 147 discusses about the reassessment. Section 148 will say a notice is required to be issued asking the SSC to file the income tax return for the purpose of assessment and reassessment. Then 149 gives the time limits, 150 gives some exceptions, is the overall aspects.